Mr. Carney said the City of London and all of its assets are together already worth 10 times more than the annual output of the rest of the UK and is set to flourish once Britain leaves the European Union. Fears have emerged that European cities including Frankfurt and Paris are trying to poach business from London amid Brexit uncertainty, but Mr. Carney said the UK will continue to thrive. He said if the UK financial system thrives in a post-Brexit world, which is the plan, it will not be 10 times GDP, it will be 15 to 20 times GDP in another quarter of century because we will keep our market share of cross-border capital flows. Well then you really have to hold your nerve and keep the focus. Get It news comes as a welcome boost amid Brexit uncertainty. Mr. Carney was speaking to The Guardian to mark the 10th anniversary of the start of the global financial crisis in August 2007. He said we have a financial system that is now 10 times the size of this economy. It brings many strengths, it brings 1 million jobs, it pays 11% of tax revenue, it is the biggest export industry by some token, all good things. But it's risky. We have a view that post-Brexit the level of regulation will be at least as high as it currently is, and that's a level that in many cases substantially exceeds international norms. The problem you have is that the same issues re-emerge under different labels, and the progress that's been made is gradually chipped away. Yesterday the bank voted to keep interest rates at 0.25% in a blow to UK savers. Andy Haldane, the bank's chief economist, decided to vote for no change after lackluster economic growth and easing inflation has dampened speculation over a hike. The decision comes a year after the bank slashed rates to the new all-time low in the aftermath of the Brexit vote. Tuesday, July 25, 2017, a faulty £1 coin which has the 2016 date on one side and 2017 in micro-inscriptions around the edge of the reverse is worth £3,000. There has not been a rise since August 2007, prior to June's inflation reading of 2.6%. There had been growing clamour for a rate rise as a Brexit-fueled increase in the cost of living ramps up pressure on hard-pressed households. Ros Andrews, director of fixed-rate bond provider, Minerva Lending, hit out against Bank of England's Mark Carney. He said this has delivered yet another body blow to the nation's savers. With UK growth forecasts downgraded by the Bank of England, the odds of an interest rate rise this year have now lengthened considerably. With the UK on slightly uncertain ground, politically and economically, a rate rise any time soon remains highly unlikely. Mark Carney has been forced to address staff issues following Bank of England strikes this week. Even when interest rates finally do start to rise, the minutes once again reminded us that any increases will be gradual and limited. With inflation likely to remain above target for some time yet due to sterling's weakness, the struggle for people to keep their savings real has no obvious end in sight. In this negative climate, more needs to be done to raise awareness of the savings risk, which is eroding people's savings pots in real terms. Clearly, when people do look beyond cash, they may wish to seek independent financial advice.